On behalf of Capital Trust Partners Private Limited, it gives me immense pleasure to welcome you to the IPO presentation and management discussion on LOLC General Insurance Limited. LOLC General Insurance is one of the fastest growing companies within the sector, with presence in Sri Lanka and in Cambodia via its recent investment in Serendip Microinsurance. The company is backed up by the dynamic LOLC Group, one of Sri Lanka's largest diversified conglomerates, with presence across multiple geographies in Asia, Africa, and the Middle East. The IPO will open on the 16th of December, and the company plans on listing the shares on the Colombo Stock Exchange Diversified Board by the 31st of December 2021. A detailed investor presentation will be carried out by Mrs. Divya Kasi-Chetty, Head of Corporate Finance, and Mr. Hasith Aliyanage, Head of Research of Capital Trust Partners Private Limited. Thereafter, we will have a panel discussion where the CEO of LOLC General Insurance, Mr. Kistiri Gunawardana, and the LOLC Group CFO, Mrs. Sanjeevani Kotakadeniya, along with Divya and Hasitha from Capital Trust Partners. They will be happy to answer questions you may have at the end of the presentation. You may type any questions you may have in the chat screen, and we will answer questions which are relevant to me. I will now hand over to you, Divya, to carry out the presentation.
Thanks, Prashani. Capital Trust Partners are pleased to co-manage the IPO of LOLC General Insurance. LOLC General Insurance is one of the fastest growing general insurance companies in Sri Lanka. Being part of the dynamic LOLC group of companies, the company is well placed to capture captive business from the group companies, in addition to other alternate channels. The company is also well placed to benefit from the regional presence of the group in growing offshore markets. We strongly recommend subscribing to this issue, priced at ₹7.90 per share, given the business case, growth prospects, and attractive valuations of a price-to-earnings ratio of 7.15 times financial year 21 earnings. The estimated fair value of this share is ₹11.80, which provides an upside of 49.37%. Let's take a look at the details of the IPO. 120 million shares held by LOLC Asset Holdings Limited are offered for sale. This amounts to a 10% shareholding in the company. The shares will be listed on the Colombo Stock Exchange Diversified Board. The offer size amounts to ₹948 million, and post-IPO market capitalization is approximately at ₹9.48 billion. The IPO will open on the 16th of December 2021. The company is interested in listing the shares on the Colombo Stock Exchange in order to enhance the corporate profile and transparency, broad-base the ownership, and have access to capital markets in order to raise funds if and when the need arises in the future to support business growth and expansion. The company hopes to list before the 31st of December 2021 for the company to be eligible for a tax benefit upon listing on the Colombo Stock Exchange. This amounts to a 50% tax concession for the year 2021, where corporate tax rate applicable for the company will be at 12%. And thereafter, for the 3 subsequent years, 2022 to 2024, a corporate tax rate of 14% will be applicable. Let's take a look at the key catalyst for growth. As you may be aware, insurance penetration in Sri Lanka is extremely low, with life insurance penetration at 0.69% of GDP and general insurance penetration at 0.7% of GDP in 2020. The low penetration level provides significant opportunity for growth as there is a large portion of untapped population. The industry is well represented and has strong presence in the Western Province, with over 32% of the branches, 62% of the industry employees, and 39% of the agents being within the province. Southern and Northwestern Province is also reasonably represented. However, there is significant opportunity for growth in other provinces across the country where presence is limited. In addition to the industry growth opportunities, it must be noted that LOLC General Insurance has a steady stream of business from captive channels within the LOLC Group of companies, finance and leasing operations. The company is looking at expanding their geographical presence within the island by increasing their branch network of 55 to 72 by 2021 and to 87 by 2022, which should contribute in increasing gross written premiums over the next few years. LGIL is expected to replicate their success in Sri Lanka in multiple geographies, given LOLC Group's presence and success in other regional markets. It is also one of the 2 local players that have presence in an offshore market through its investment in Cambodian insurance company Serendib Micro Insurance. In addition from benefiting from the group's operations, the company has been successful in growing non-captive channels, including bank assurance, direct corporates, and agents. Gross written premium contribution from this segment currently stands at 50.9% and is expected to steadily grow to 54.25% of GWP by 2026. Going forward, in addition to the motor segment, the company will be aggressively growing the non-motor segment, which consists of fire, marine, workman compensation, etc. The contribution from non-motor segment is expected to continue to increase from 16.7% recorded in 2020 to 20% in 2026. This segment recorded strong growth during January to August 2021, where fire, marine, and miscellaneous recorded a growth of 59.2%, 228.4%, and 121.5% year-on-year, respectively. The group has also maintained strong underwriting efficiency compared to the industry. As a result of the strong underwriting and operational efficiency, LGIL's combined ratio averaged at 98% during 2017 through to 2020, better than the industry average of 99% recorded during the same period. We expect the company to continue to maintain strong underwriting efficiency with a claim ratio, although higher than what was recorded during the pandemic year 2020, to continue to be lower than the industry going forward. The net expense ratio is expected to remain in line with the industry as the company is growing its non-captive segments, incurring a higher customer acquisition cost. A lower combined ratio than that of the industry is expected to be continued to be maintained by the company going forward. Let's take a quick look at the financial highlights and key considerations that would assist you in making an informed decision about this investment. Capital Trust Partners has carried out a detailed research on the industry and the company, and a financial forecast and model on LOLC General Insurance. We will discuss the forecast and assumptions in detail later on in this presentation. A number of valuation methods were considered, but concluded that the discounted cash flow and the forward price earnings relative valuation methods were more appropriate to value LGIL compared to the other methods. Providing an equal weightage on the discounted cash flow method and the forward PER method, we arrived at a weighted average equity value of 11 rupees and 80 cents per share. The issue price of 7 rupees and 90 cents is at a discount of 33.05% to the fair value of 11 rupees and 80 cents per share. The valuation is very attractive, with the implied forward PE at 7.15 times 2021 net earnings and 6.68 times 2022 forecasted net earnings, compared to the industry average PE of 8.99 times. In addition to the attractive valuation, we must consider some important aspects of the company and its growth prospects. As mentioned, the company is one of the fastest growing general insurance companies in Sri Lanka, with GWP compound annual growth recorded at 17.2% from 2016 through to 2020. We have conservatively forecasted that the gross written premium will grow at a compound annual growth rate of 16.45% from 2020 through to 2026. Investment income is expected to be a strong growth pillar with 23.47% CAGR through 2020 to 2026. LGIL's investment yield is higher than the industry and is recorded at 8% versus the industry's investment yield, which was recorded at 7.2% in the first half of 2021. The company is forecasted to continue to maintain strong underwriting and operational efficiencies. Net claims ratio and net expenses ratio expected to average at 60% and 39.1% respectively for the forecasted period of 2022 to 2026. This results in a forecasted average combined ratio of approximately 99.1% for the period of 2022 to 2026. The company has a strong balance sheet with an asset base of 11.1 billion rupees as at end of August 2021, of which investment securities amount to approximately 71.2% of total assets. The company is well capitalized with total available capital of 3.3 billion rupees and a capital adequacy ratio of 238% as at 30th June 2021, which is well above the regulatory requirement of 120%. The DCF considers a cost of equity of 16% with a terminal growth rate of 2% and accordingly derives a value per share of 13 rupees and 67 cents. The forward price to earnings relative valuation method considers the industry peer average trailing PE of 8.99 times, which derives a value per share of 9 rupees and 93 cents. The fair value is conservative, as we believe the company should trade above the industry peers, considering the strong historical growth, regional presence in Cambodia, and LGIL's ability to replicate the success of its Sri Lankan operations in multiple geographies that LOLC Group operates and has a captive customer base. As mentioned previously, we assign a fair value of 11 rupees and 80 cents based on financial year 21 forecasted earnings. This has been arrived at considering the discounted cash flow method and a forward PE relative valuation method, which has been given a 50% weightage each. The ultimate parent company of LGIL is LOLC Holdings, with an asset base of 959.5 billion rupees as at end September 2021. LOLC General Insurance is presently owned 73.75% by LOLC Asset Holdings Limited and 26.25% by LOLC Financial Sector Holdings Private Limited. LOLC Asset Holdings has agreed to sell 10% of the shareholding in the company at 7 rupees and 90 cents in order to facilitate the company to list its shares. The balance shares held by the existing shareholders will be locked in for a period of 6 months from the date of listing or 12 months from the date of allotment, whichever is longer. Let's take a few minutes to discuss a brief overview of LOLC General Insurance. The company commenced operations in September 2011 and has since recorded a steady growth in Sri Lanka and ventured to offshore markets with an investment in Cambodia, where they acquired a 45% shareholding in Serendip Microinsurance in April 2020. The company offers a full gamut of products, including motor insurance, fire insurance, marine insurance, workmen's compensation insurance, etc., and has over 300,000 active policies. The company has a growing presence island-wide with over 55 branches and 518 employees. Impressive financial performance was recorded for the first 8 months of the year from January to August 2021, with GWP recorded at 4.97 billion rupees, which is a 17.1% growth year on year. The company recorded strong underwriting and operational efficiency as reflected in the low combined ratio of 89.1%, with net claims ratio at 47.8% and net expense ratio at 41.3% during this period. The profit before tax was recorded at 875.1 million rupees for the period of 8 months ending August 2021. Let's take a look at the key pillars of growth and strategy of the company going forward. With the aim to enhance customer experience and improve efficiencies in servicing clients, the company invests in latest IT solutions. In order to reach untapped clients, the company has plans on expanding its existing branch network, consisting of 55 branches by 17 in 2021 and 15 in 2022, and plans to add 4 kiosks over the next year. The company made an investment in Cambodia in April 2020 and acquired 45% shareholding in Serendip Microinsurance. The group already has a presence in Cambodia through its microfinance company, LOLC Cambodia, which will provide a steady stream of captive business to the insurance arm. In addition, LOLC GI will be able to replicate its success in Sri Lanka in multiple geographies in the future, considering LOLC's group presence across Southeast Asia, South Asia, Central Asia, as well as Africa. The company also continually focuses on development of human capital and increasing the number of agents in order to grow the non-captive segment. As mentioned previously, within a short time frame, LOLC GI has already ventured overseas to Cambodia and is well placed to benefit from group synergies. LOLC GI will be able to replicate its success in Sri Lanka in multiple geographies in the future, considering LOLC Group's presence across Southeast Asia, South Asia, Central Asia, as well as Africa. The insurance industry has 27 players, of whom 13 operate in life insurance, 12 operate within the general insurance, and 2 composite insurers. The regulator, Insurance Board of Sri Lanka, mandated all insurers in 2015 to segregate life and general insurance businesses into 2 separate standalone entities. This initiative brought about industry consolidation, resulting in operational efficiencies and stronger financial position among industry players. Draw your attention to the pie chart. This shows you the market shares of the players within the general insurance industry in 2020. Sri Lanka Insurance is the market leader with approximately 18.4% market share, followed by Selinco with 17.7% market share, and Alliance with 13.2% market share. National Insurance Trust Fund and Fairfirst has a market share of 11.4% and 11.3% respectively. These are followed by People's Insurance with a market share of 5.4% and LOLC with a market share of 5.3%. The market share of smaller players declined during 2016 through to 2021 due to the consolidation process of the industry that commenced in 2015. However, LOLC GI witnessed an improvement in its market share from 3.9% in 2016 to 5.3% in 2020, based on industry GWP, given the dynamic growth strategies employed by the management. The industry as a whole recorded a CAGR on GWP of 7.2% in 2016 through to 2020. The average combined ratio, which measures the underwriting and operational efficiencies, was recorded at 99% in 2016 through to 2020. 58.1% of general insurance GWP contribution was from the motor segment in 2020. The number of new registrations reduced by 44.8% year-on-year in 2020. Limited access to customers during the pandemic and deterioration of affordability of the insurance premium of consumers were also contributing factors to the reduction in GWP in the general insurance sector. Despite these factors, GWP of general insurance industry only dipped 2.24% year-on-year from 107.7 billion rupees to 105.3 billion rupees in 2020. In the first half of FY21, motor sector GWP declined 5.35% year-on-year to 46.99 billion, and health segment GWP dropped by 25.38% year-on-year to 9.79 billion rupees. Despite these setbacks, the general insurance industry GWP saw a dip of only 3.67% year-on-year to 77.4 billion rupees in the first half of 2021, as it was supported by fire, marine, and other segments. Now that we have a better understanding of the industry, let's take a closer look at LOLC GI's historical performance. As mentioned before, LOLC GI is one of the fastest growing general insurance companies, recording a GWP CAGR of 17.2% and a net earnings CAGR of 50.4% during 2016 through to 2020. With a market share of 5.33%, it is the seventh among the general insurance sector players in Sri Lanka. The company has a competitive advantage over most other players and benefits from captive business through LOLC Group's finance companies. Looking at the graph, it is evident that the company has been steadily growing over the last few years, with GWP at 6.11 billion rupees, which is a 15.3% growth over the previous year. LGIL's GWP dipped 17.7% for the first half to 3.6 billion rupees. This was mainly due to the 99.57% year-on-year drop in workmen compensation insurance. However, growth strongly rebounded in the third quarter, resulting in a 17.12% year-on-year growth in January to August 2021. As mentioned previously, the company benefits from a captive base from motor insurance backed by its own group finance companies, LOLC Finance, LOLC Development Finance, and Commercial Leasing and Finance. These channels contributed to 53.3% of the share in GWP in 2020. However, has since reduced to 49.1% from January to August 2021. The company has made strong efforts to grow its non-captive channels, and accordingly, contribution from captive channels is expected to further reduce to 45.8% in 2026. As reflected in the graph, the motor sector contribution averaged at approximately 85% over 2018 to 2020. It has since reduced to approximately 80.2% in January to August 2021, although it continues to dominate LGIL's GWP from both captive and non-captive channels. Strong double-digit growth in GWP is expected at a CAGR of 16.5% over 2021 to 2026. This growth is expected to be generated through increasing footprint through branch expansion from 55 to 87 by 2022. Further growth is expected to be supported by an increase in the non-captive segment by entering into new partnerships with leading banks, targeting mid to large-size corporates with customized insurance policy solutions, and increased focus on corporate accounts through well-established relationships with top brokers. Looking at the graph that reflects channel-wise contribution to GWP, it is evident that during January to August 2021, group companies LOLC and CLC contributed 49%, while GWP contribution from agents was at 16.6%, bancassurance at 12.4%, and brokers at 9.8% during January to August 2021. We expect contribution from non-captive segments, direct corporates, brokers, and bancassurance segments to be at approximately 8%, 10%, and 13% to GWP respectively, on average over the forecasted period ending 2026. This slide reflects the partnerships that have been established by LOLC GI with other financial institutions. In addition to the group companies, the company has partnered with Commercial Bank, Ceylon Bank, Sampath Bank, and Regional Development Bank, and hopes to enter into new partnerships over the next few years.
Thanks, Divya, for the detailed brief on the industry and LGIL's position compared to its peers. Now let's move on to LGIL's performance and its associated valuations. LGIL's assets grew at 20.6% year-on-year to 9.1 billion in 2020, and the company accounted for 4% of the general insurance industry assets. In first half 2021, LGIL's assets accounted for 4.9% of the industry assets of 213.8 billion. LGIL's assets amounted to 11.1 billion as at end of August 2021. As indicated in the asset mix chart, the government securities accounted for 39.5% of assets, premium receivables, investments in unit trusts, and commercial papers amounted to 17.3%, 12.2%, and 10.4% respectively. LGIL's investment securities mix as of end of August 2021 consisted of treasury bonds of 51%, unit trusts of 17%, commercial papers of 15%, corporate debentures of 11%, repos of 3%, treasury bills of 2%, and term deposits of 1%. LGIL's investment income grew by 25.1% year-on-year to 529.5 million in 2020 and 14.3% year-on-year in January to August 2021. The growth in January to August 2021 was mainly led by interest income from treasury bonds, which increased 29.5% year-on-year, subordinate debenture interest, which increased 75.5% year-on-year, interest income from senior debentures, which increased 90.7% year-on-year, and interest on commercial papers, which increased 38.1% year-on-year. LGIL's investment yields is higher than the industry at 8% in January 2021 and 8.2% in August 2021 versus 7.2% for the general insurance industry in the first half of 2021. In January to August 2021, the GWP mix consisted of higher contributions from the motor segment at 80.2%, while the fire segment contributed 16.5% to the GWP mix, while miscellaneous, marine, and worker compensation insurance added 2.4%, 0.7%, and 0.2% respectively. LGIL has a competitive captive customer base for motor insurance backed by its own group finance companies, including LOLC Finance, LOLC Development Finance, and Commercial Leasing and Finance. LOLC's captive segment contributed 49.1% to GWP during January to August 2021 versus 53.3% in 2020. In comparison, LGIL's performance during January to August 2020, the contribution to GWP from the motor segment dropped from 85.6% to 80.2%. LGIL's GWP growth was dominated by fire, which increased 72.3% year-on-year, marine, which increased 279% year-on-year, miscellaneous, which increased by 146% year-on-year, and motor, which increased by 9.2% year-on-year. A similar trend continued in January to August 2021, where fire, marine, miscellaneous, and motor segments grew by 59.2%, 228.4%, and 121.5% and 9.8% year-on-year, respectively. Net claims ratio of the general insurance industry dropped from 66.3% in 2019 to 49.2% in 2020. Claims across all classes dropped due to the impact from the pandemic in terms of travel restrictions and lockdowns imposed. Fire and health segment recorded the highest net claims ratio of 87.3%, and 81.9% respectively. Motor insurance net claims ratio dropped from 58.8% in 2019 to 46.5% in 2020. LGIL's net claims ratio was 39.8% in 2020 and 47.8% in January to August 2021, which is much lower than the industry average, showing its stringent underwriting processes. LGIL's net expense ratio recorded at 41% in 2020 and 41.3% in January to August 2021. The increase in net expense ratio in 2020 and 2021 compared to the industry was due to the company growing its non-captive segments, incurring a higher customer acquisition cost. LGIL's net combined ratio recorded at 80.7% in 2020 and 89.1% in January to August 2021. The combined ratios of LGIL reflects the efficiency of the company's underwriting standards. However, the drop in the ratio during 2020 was due to the one-off impact from the COVID-19 pandemic. Amongst listed companies which disclose financials of their general insurance businesses during 2020 and first half of 2021, LGIL recorded the lowest combined ratio as indicated in this graph. This reflects the efficiency of LGIL's underwriting standards amongst listed general insurance companies, as well as its cost-effective operating environment, even when the company is incurring higher acquisition costs in growing its non-captive segments. Gross written premiums in 2020 amounted to 6.1 billion, which represents a 15% year-on-year increase compared to 2015. The growth in GWP slowed down in 2020 due to the import restrictions placed on motor vehicles, resulting in lower number of motor policies underwritten. Due to travel restrictions imposed in 2020, the total number of insurance claims reduced on a year-on-year basis, resulting in the net claim ratio decreasing to 39.8%. Despite the easing of travel restrictions, the net claim ratio for the year to date up to August 2021 is only 47.8%, given the stringent underwriting policies employed by management. As explained before, due to the high acquisition costs associated with the non-captive policies, the net expense ratio has deteriorated in 2020 and 2021. As a result, the expense has increased to 1.8 billion in 2020 and 875 million in January to August 2021. Net profit increased by 25% in 2020 to 1.1 billion and stood at 665 million from January to August 2021. The PBT margins as a percentage of GWP increased to 25% due to the lower claims experience. Now that we have evaluated the industry and the historical and year-to-date performance of the company, let's move on to evaluating the financial forecast. Backed by double-digit growth in direct corporate, broker, agents, bank assurance, and partnership channels, we have assumed the GWP CAGR of 16.5% over the period of 2020 to 2026. We have assumed the non-captive segment will increase from 46.7% in 2020 to 54.3% by 2026 due to the growth in the segments other than motor. Yet, we will still expect the GWP mix to be dominated by the motor segment with a contribution of circa 80% over 2021 and 2026. The non-captive segments such as the fire segment, which has reported strong growth in 2021, is expected to increase marginally to 16.8% by 2026. While the contribution for marine, miscellaneous, and worker compensation insurance are assumed to be 0.7%, 2.4%, and 0.2% respectively. Reinsurance as a percentage of GWP is forecasted to range from 14.6% to 14.8% over the forecasted period. The net change in reserves for unearned premiums as a percentage of GWP is assumed at 15% during the forecasted period. Due to the recent change in interest rates, we have forecasted investment income, which recorded a 18.5% CAGR from 2016 to 2020, to record a 23.5% CAGR through 2020 to 2026, considering the current investment securities mix and the investment yield of 8.6% in August 2021. We have taken a conservative view on the net claims ratio and have assumed the ratio to be higher at 56.8% in 2022 and increase to 60.8% through 23 to 2026. This is conservative given the average net claims ratio recorded during 2017 to 2019, which was the pre-pandemic, was only 57.6%. This is due to the easing of the lockdowns and the travel restrictions countrywide, and the possibility of relaxing in restrictions on motor vehicle imports, resulting in higher motor claims. Other operating and administration expenses are forecast to be in line with 25% of GWP throughout the forecasted period. GWP is forecast to increase by 22% to 7.46 billion in 2021 and increase by 16% in 2022 to 8.7 billion. Investment income, which is one of the main profit drivers for the general insurance sector, is forecasted to increase by 34% in 2021 to 711 million. Investment income is forecast to increase by additional 39% in 2022 to 990 million. We maintain a conservative assumption on net claims ratio of 47.8% in 2021 and 56.8% in 2022. As such, claims benefits are forecasted at 2.4 billion in 2021, which is a 34% year-on-year growth, and 3.5 billion in 2022, which represents a 39% increase in claims on a year-on-year basis. Due to the listing process, the company will benefit in the form of a concessionary income tax of 12% in 2021 and 14% for 2022 to 2024. As a result, net profit is forecasted at 1.33 billion in 2021 and 1.42 billion in 2022, which translates to a growth of 19% in 2021 and a conservative 7% in 2022. The company's total assets are forecasted to increase by 22% to reach 12.1 billion in 2021 and forecast to increase a further 17% to reach 14.1 billion in 2022. The company's equity to shareholders is forecasted to increase by 44% to reach 4.42 billion in 2021. The total equity to shareholders in 2022 is forecasted to increase by 32% to reach 5.84 billion. Having discussed the financial forecast, now let's evaluate the company valuations. We have considered a DCF valuation, which is the most appropriate valuation methodology for general insurance companies. We have also considered the PE-based valuation methodology on forecasted FY21 earnings. In addition to the above, we have also considered additional alternative valuation methods. We have derived a valuation of rupees 13.67 per share based on a DCF valuation method. We have used cost of equity at a conservative 16%, terminal growth of 2%, equity to capital ratio of 100% to arrive at a weighted average cost of capital of 16%. The IPO price of 7.9 rupees per share is at a 42.21% discount to the discounted cash flow based valuation. The upside from the issue price of 7.9 per share to the DCF based valuation of 13.67 is attractive 73%. An equity value of 9.93 per share has been calculated using a forward price to earnings ratio based method. This is assuming that the company will trade on par with the current industry average PER of 8.99 times, which is a 33.82% discount to the current broader market PE of 13.6. This considers the trailing earnings of local listed insurance industry peers through fourth quarter 2022 to third quarter 2021, and the current market trading prices of each company to arrive at a fair value. We have applied the industry PE of 8.99 times on the forecasted EPS of 1 rupee and 10 cents for 2021 to arrive at an equity value of 9.93. It is also important to note that the direct comparable peers such as People's Insurance and Amana General Insurance are the only listed insurance companies that operate solely in the general insurance segment and trade at a much higher PE than the life insurance or composite insurance companies that operate both in general and life insurance. Fundamental valuation methodologies such as trailing PER and PBV relative valuations were also considered in addition to the DCF and forward PE methods. Trailing PER is based on actual net earnings recorded over a period of the last 12 months. This includes net earnings in the period of January to August 2021 and September to December 2020. Given the EPS of 0.82 and a PE of 8.99 times, we arrive at a valuation of 7.43 rupees per share. The issue price is at a premium of 7.63% to the trailing PER based valuation. We believe that the premium is justified given the fact that LGIL's historic net earnings do not fairly represent the future earnings growth, considering the changes in the operating environment and tax benefits. The factors to consider include the strong GWP growth through improving non-captive channels and the steady growth in investment income. The forecasted net asset value per share for 2021 is forecasted at 3.68 rupees per share. The industry is currently trading at a PBV of 1.06 times. Thus, we arrive at a valuation of 3.9 rupees per share on a PBV valuation basis. However, it must be noted that the PBV should not be looked at in isolation and should be considered along with the return on equity. LGIL recorded a strong return on equity, which averaged over 30% in 2019 to 2020. This is in comparison to the average industry return of equity of 13% based on trailing earnings of listed peers. Considering the high return on equity coupled with the high retention rate, we expect the sustainable growth rate of the company to exceed the industry growth. Accordingly, a higher PBV compared to the peers can be justified. As explained previously, LGIL is forecast to achieve a net profit of 1.33 billion and 1.42 billion in 2021 and 2022 respectively. This is driven by strong growth in GWP, investment income, and tax benefits expected by the listing process. The share is attractively priced at a PE of 7.15 times 2021 earnings and 6.68 times 2022 earnings, representing a discount to the industry PE of 8.99 times and the broader market PE of 13.6 times. The return on equity is strong at 30% in 2021 and 24.3% in 2022. The return on equity is low in 2022 due to the conservative assumptions placed on the claims being higher in 2022. As mentioned in the previous slide, the IPO price of 7 rupees and 90 cents per share is at a 42.21% discount to the DCF based valuation and a discount of 20.44% to the forward PER based valuation. If we assign equal weightages to the primary valuation methodologies of the DCF and the forward PE based valuations, The proposed issue price of ₹7.90 per share represents a 33.1% discount to the weighted average value per share of ₹11.80 per share. At the issue price of $7.90 per share, the IPO provides an upside of 49.37% to the fair value of ₹11.8 per share. As mentioned before, LGIL is trading at a discount to the industry PE of 8.99 times, but we expect it to trade at a premium compared to the industry peers due to the following salient features: strong growth forecast and high return of equity, a regional presence in Cambodia, the ability to replicate this model and expand into multiple geographies across Asia and Africa that the LOLC Group has established presence. This gives investors exposure to captive markets across multiple geographies globally. As mentioned before, the issue is attractively priced at an implied PE of 7.15 times 2021 earnings and 6.68 times 2022 earnings, versus industry trailing PERs of 8.99 times. The return on equity is expected to continue to exceed industry average, with the return on equity averaging at over 30% versus the industry trailing return of equity of 13%. This is a summary of the key dates associated with the IPO. As mentioned before, the IPO will open on the 16th of December and is expected to close on the same day. With regards to the payments, please note the checks will be in cash on or before the 20th of December. It's also important to note that as per expectations, bank guarantees will be called on after allotment is finalized on the 27th of December. Please note the shares should be listed on the 31st of December, thus providing investor liquidity in almost 14 days. This is the brief on the valuations and the financials from our end. Please give us a minute to coordinate the Q&A.
We thank you, Hasita Divya, for your valuable insights. Now, Mr. Sandip Jayakodi, Deputy General Manager of Capital Trust Securities, will read out some of the questions that are relevant to many clients, which have been sent through the chat by the audience.
Thank you, Prashani. Thank you, Hasita and Divya, for that in-depth presentation. Good evening, ladies and gentlemen, to this presentation. Today, we have Mr. Kitsiri Gunawardena, Group CEO of LOLC General Insurance, and Mrs. Sanjeevani Kotagadenia, Group CFO, to answer some of the questions that you have posted. I would like to start off this session by asking you, Mr. Gunawardena, the first question is about the insurance penetration in Sri Lanka is very low for both general and life insurance. It's approximately 0.7% of GDP. What are the main reasons for this, and what initiatives can be undertaken to increase this?
Thank you, Asper. Am I audible? Am I heard?
Yes, we can hear you.
Well, what you said is true in terms of life as well as general. The level of penetration in Sri Lanka is low. One of the reasons, of course, obviously, is the fact that the income levels of our people would have not been facilitating the requirement of insurance in the past. But in the recent past, as you know, Sri Lanka has moved from a low income to a middle income level country. So with those circumstances, we believe that there is great opportunity for general insurance companies as well as life insurance companies to expand the penetration by introducing policies which can be managed by the sector. So this is one of the challenges, and I believe that LOLC, with the kind of emphasis and with the expertise that we have acquired in servicing the small, micro, and the medium sector, are very well placed to take opportunity from with regard to general insurance in introducing policies which are of value for small businesses, small households, and so on and so forth. So we look at that as in a sense as a blue ocean where there is opportunity for growth. And as we have been doing in the last couple of years, we hope to expand on that in that area and to introduce policies as well as that area to be able to service our customers in that sense.
Yeah, again, I would like to pose another question to you, Mr. Gunawardena. In 2020, despite the pandemic, your profitability improved. So what was the main strategy and the reason behind this?
Well, with the onset of the pandemic, as you probably know, the general sentiments in Sri Lanka and the business community to a large extent was one of uncertainty and trying to sort of cut back on the kind of financial and provision of services. But we took it as an opportunity. I mean, both the companies, Life as well as General, we took it as an opportunity that was presented to us, and we actually went on a very aggressive campaign in order to expand our services and provide services to our clients, particularly bank assurance clients and so on, with sort of great agility. And that, I think, gave us the opportunity of expanding and increasing our market share as well. So our staff was quite motivated in order to do this. And also as we mentioned, our investments, and we are supported by the LOLC IT companies, which have invested in the latest of technology with IT security. So these platforms made it actually quite feasible for us to serve our customers and to increase our market share in the general insurance sphere.
Right. I would like to pose this question to Mrs. Sanjeevani. We have noted that over the years, your net expense ratio has been above the industry average, but now in recent times, it's lying with the industry. What are the reasons for this, and are we likely to see this trend continue going forward?
Sorry, can you just repeat the question again? Didn't hear it quite well.
Your net expense ratio has been above the industry average, but now we see that it is lying with the industry. We'd like to know the reason for this and whether we are likely to see this trend continuing going forward.
Yeah. It's actually because, as you know, LOLC General Insurance has been in operation only for like about 10 years. And therefore, the first few years, what we have been doing is growing the business. So you can see we have opened quite a few branches, expanded the footprint. So with that, actually our expense, it's normal that an insurance company in its early years would have a higher net expense ratio because the admin expenses as well as the establishing the sales channels is expensive. So those are the reasons why our expense ratio has been a little higher. And towards the latter part, I think now we are settling in and our infrastructure has been put in place and our branch expansion still continues, but we are actually more or less set up. So that's why the expense ratios are now coming to the industry level, and we believe that we can be quite competitive in the net expense ratios going forward.
I'd like to pose another question to you, Ms. Sanjeevani. In recent times, we have seen TB rates were increasing, but then in the recent past, also we are seeing the rates are declining again. How will this affect the interest income generated and the profitability going forward?
Can you repeat the question again? We can't hear you well.
In recent times, T-bill rates were increasing, and the expectation was the T-bill rates to keep increasing. But however, in the last 3-4 auctions, we've seen a decline. Do you see this affecting your profitability going forward in terms of interest income generated?
Certainly, actually, for insurance companies, we are regulated by the directions given by the RCSA, especially on investments. So we have to maintain, actually, most of the investments are in treasury bonds and bills. And so therefore, definitely, like in the short term, yes, we will be affected, but we believe that our investment income over a period of time should increase from the current levels. That's our expectation. That's what we have forecasted.
Right. Divya and Hasita, I would like to pose these questions to you. In terms of the projections that you all have done, have you all taken into consideration the overseas expansions that are taking place, or is it purely based on what is happening in Sri Lanka?
So Sandesh, actually our projections are very conservative. We have only factored in the expansion and the Sri Lankan operation. So the potential is actually much more when you factor in the overseas expansion. But at this point in time, given the stage that the company is at as well, we didn't factor that in. So the projections are extremely conservative.
There's another question from the audience, and again, I'll ask it from you, either Hasita or Divya, you can answer this. From a valuation perspective, why hasn't the PBV been taken into consideration as a primary method of valuation?
Just adding to that. So basically, for general insurance companies, we feel the DCF sort of valuation methodology should be the primary valuation method, as it better represents the sector, where you discount future cash flows accordingly. PBV is not as applicable for LGIL, especially because their return on equity is almost 3 times the industry average, where they're averaging around 30% return on equity, where their industry is around 13%. So if you apply the industry average PBV of 1.06, it doesn't. It's not really fair on LGIL's valuation. So we have looked at it, but given the high return on equity, we feel that it should trade at a premium to the industry in terms of PBV multiples. For that reason, we've excluded it from our primary valuation methods and stuck to the DCF-based valuation as well as the forward PE-based valuation. Because we need to account for the fact that general insurance policies are short-term of nature and not really long-term policies like life insurance. So you can't really look at a PBV-based valuation for that. It should be more or less based on cash flows.
Right. There's another question from the audience, and this question I'll direct it to Mr. Gunawardana. What are the strategies that your company has adopted to be one of the fastest growing insurance companies in Sri Lanka?
Primarily, I think like in 2020, the COVID pandemic gave us an opportunity of being aggressive and taking a very positive attitude towards business, which helped us. Secondly, also the aspect of introducing, we came up with a strategy of having branches throughout the country, our own branches, we moved out. And also the investments that we had done in acquiring latest technology in terms of evaluating claims and underwriting and so on. And apart from that, actually the commitment of the staff are highly motivated. They're a happy bunch of people. So I think these are some of the things that have helped us in becoming what it is, and good HR practices. So all these are factors that went into making the company what it is now. And we intend to introduce some other features as well as we go along in terms of investments and broad basing our investments and so on, that should help the company to grow even faster.
There's another question, Mr. Gunawardena. It's in terms of, again, about growth. The question is about which segment do you expect to see the highest growth, and what are the reasons for it?
As the numbers indicated, about 80% of the business, 80% of our business portfolio comprises of motor. As we spoke, there is a lot of opportunity in the non-motor sector. Tourism sector is to grow, and as I mentioned, the LOLC Group, with the kind of strong expertise that we have in small and medium sector and the micro sectors, we believe that non-motor sector, when it comes to households, small households and small businesses, those things like pharmacies, things like salons, all these small business ventures, there is great opportunity for any party to grow. So we believe, in that, in those areas. Independent of that, with our affiliation with the port city and the decisions that we have made with regard to the land and so on, we believe that there will be opportunities that will be open for the insurance company in the group for those large industrial and construction projects as well.
There's another question from the audience, and it's I'll direct it to Mrs. Sanjeevani. It's with regard to the forecasted valuations that has been done. Is the company on track to achieve the forecasted profitability for the financial year 2021?
Yeah, actually, yes. I think we don't have a problem. As of September itself, I think we had reached quite close to the target. So by December 31st, we should be able to make I'm quite confident that we can make the 1.3 billion that we have forecasted for 21.
Yeah, there's another question, which again, I will direct it to you. What sort of contribution are you expecting from Cambodia over the next 2 to 3 years? And what are the other contributions that are expected from rest of the markets?
If you look at our forecast, does not take any contribution, any significant contributions from Cambodia, because actually we just started the operations. The first month was just completed. So compared to the LOLC GI Sri Lanka business, the contribution that will come in the first couple of years may not be significant relative to that, the growth in Sri Lanka. So we have not built anything significant into the forecast, but we strongly believe that there's very strong potential for growth, because we will be actually the company LOLC Cambodia will actually, they have already started doing business for us. So that company is actually one of the largest micro finance companies in Cambodia, and their growth is quite, I would say, very robust growth in Cambodia. So we believe that the contribution will be significant in the long run. But in the first couple of years, we have not forecasted anything significant compared to the contribution that comes from the local company, because we also have some amount of expenses that we have to incur in setting up the business in Cambodia. And we have, in our forecast, we have not forecasted for any other countries that LOLC is operating in to start business. But we will be, and the group will be expanding into the other areas as well. And there's potential for micro insurance in those countries as well.
Right. There's a question again from the audience. I'll direct it to you, Mr. Gunawardana. The question is, are there any new products that you hope to launch over the next year?
Actually, we have a quite a comprehensive array of products to service all sort of segments. There's nothing sort of exceptional that has been discussed at the moment with regard to new products as such. But LOLC General there was a handicap last year and prior to that with regard to engaging in medical, which is something that is taken over, which is engaged in by all other general insurance companies. So all our progresses and the growth that we have made was devoid of being involved in medical. So going forward next year, we will be taking steps to introduce and to serve our customers with medical policies as well as in the case of other general insurance companies. So we believe that with that we'll be able to give comprehensive solutions to entities, banks, and so on, in quoting all the areas of general insurance that is usually available with our competitors.
Right. There's a question again from the audience with regard to how you differentiate yourself from your competitors. What's the competitive, how do you?
Well, LOLC, LOLC Insurance itself shares in the culture and the innovation and so on of the LOLC Group. So we are a very bottom line oriented, bottom line emphasis oriented company. And when it comes to our main differentiation, the way that I look at would be our strength in small and medium and micro sectors. While we serve the largest of the projects in the country, we will also be interested and also introducing mechanisms to service a large majority of people in this country who do not have access to insurance because of the fact that the kind of interest that ought to have been taken in these sectors have not been taken. So we hope to go in that direction, as in the case with the LOLC Group, Sri Lanka and elsewhere, how we have done. So that I see as a differentiation that we have, and that's in terms of insurance, as you would appreciate, it's a numbers situation where you diversify your interest with a large granular portfolio. So in this segment, I think we'll be quite, that would be the differentiation that we like to harness, and we would tap into going forward.
There's a question, I'll direct this to Ms. Sajivani. What are the longer term growth plans that you all have for LOLC General Insurance?
Can you repeat the question again, please? Growth plans you asked.
What are the long-term growth plans that you have for the company?
Yeah, that's a good question, because in terms of general insurance, one aspect that we would like to explore would be the opportunity that is presented because of the fact that we are affiliated with a group like LOLC. We have presence in 16 countries in Asia and Africa. So all these are potential markets where there is great opportunity for general insurance business to be introduced. And in all these markets, one other fascinating fact is that the penetration levels in small and medium sector is quite low, not only in Sri Lanka, even in other markets in Africa and Asia where we are present. So we see this as a long-term opportunity for the group as well as the LOLC General Insurance in order to expand into these markets, which we would be undertaking in time to come. At the moment, as I think Mrs. Kotakadeniya mentioned, we are already present in Cambodia. There are discussions to engage in, to operate, to initiate such an operation in Myanmar. And thereafter, we'll be moving into other countries. And as you know, as opposed to Sri Lanka has a population of about 21-22 million. But then if you think of countries like Indonesia, Pakistan, and some of the countries in Africa, the kind of potential that is available simply because of the population itself is rather great. So that is the long-term growth plans, but those would eventually come. That would not come in the next 1 or 2 years. But once the markets, in terms of the financial institutions that we have in those countries, once those acquire accepted level of maturity, their insurance will follow life and both general.
Hasita and Divya, this question is for you. I think this is the most important questions as far as the investors are concerned. What can the investors expect in terms of returns from this IPO? Can this be like an expat where the short-term returns are fairly high, or are we asking the investors to come in with a longer-term view? What are the expectations in terms of share price?
So Sandesh, as we mentioned in our presentation, the fair value for the share is at 11 rupees and 80 cents based on financial year 21 earnings. So this alone provides an upside of 49.37% in the short term. But in addition to the short-term upside potential, long-term prospects also of this company must be considered. We need to keep in mind the company is one of the fastest growing insurance companies, and they have a very strong profit track record with net earnings growing historically at a CAGR of about 50.4% from 2016 to 2020. In addition, they have ventured out to Cambodia within a very short time frame, and they're very well placed to replicate the success they have achieved in Sri Lanka across multiple geographies where LOLC Group has an established presence in finance and leasing. So these factors have not been considered in the projections. So you need to, in addition to looking at the short term, yes, there is an immediate short term price appreciation potential, but the long-term growth prospects of the company is significant, and that should also be considered when investing.
Right. Again, I'll pose this question to either you or Hasita. There's a question from one Mr. Visham. His question is, how does the share prices of CLC, NIFL and LOFC influence the IPO price of LOLC Insurance?
Firstly, I think we should keep in mind there is no relationship between the LGIL's share price and CLC and LOFC. But on top of that, what we need to keep in mind is, I think CLC is trading at around a 53 times PE based on trailing earnings, and I think LOFC is trading at around 17.5 times trailing 12-month earnings. But as per the issuance price of 7 rupees 90 cents, LGIL is priced at 7.15 times 2021 PE and around 6.68 times 2022 PE, which is both way below the broader market PE of 13.6 times, as well as the industry average of 8.99 times. So we feel LGIL is priced way below its fair value, whereas counters like CLC and LOFC has passed its fair values. And in our view, whatever counter goes past its fair value will correct in the medium term. So in this case, since it's trading below its fair value, we expect an appreciation. But I think all the counters we mentioned should be looked at in isolation, and shouldn't be looked at in where there is some sort of correlation as such. So we expect LGIL to do well on its own, regardless of the performances of CLC or LOFC.
Right. I think we have covered most of the questions, and since there are no more questions, I would like to bring this Q&A session to an end. I would like to thank Mr. Kitsiri Gunawardana and Mrs. Sanjeevani Kotakadeniya for joining us, along with Hasita and Divya for answering all the questions. And now I would like to hand it over to Prashani to conclude this presentation.
Thank you very much. Since there are no further questions, I would now like to close the investor presentation. On behalf of Capital Trust Partners Private Limited, I wish to extend a sincere thank you to the LOLC management team, especially Mr. Kitsiri Gunawardana and Mrs. Sanjeevani Kotakadeniya for joining us this evening, and for our staff who helped to organize this presentation, and for our valued clients for their support and continuous trust in us. Please note that you can access the application forms along with the prospectus and other relevant information regarding the LOLC General Insurance IPO via the website www.ipo.capitaltrust.lk. Thank you very much. Have a nice day.